How to protect your investment from stock market crash. When the stock market crashes, it is important to consider your investments to make sure that they are protected. Here are some ways to protect your investments from the stock market crash. This video will provide useful information for those who are concerned about protecting their assets during a volatile period in the market. In this video, we will explore some of the most significant factors that you should look out for to protect your investments from a stock market crash. Welcome to Stocks Galore, the place for those in passionate pursuit of financial freedom. Smash the like button now, subscribe to our channel and click the notification bell to be notified when new videos are released. A lot of people struggle with understanding the market and investing. It's one of the most complicated industries out there. Investors need to know what they are doing before they even start investing in the first place, otherwise, they may end up making poor decisions without realizing it. It's important to protect your investments from the volatility of the stock market. Keeping your investments in safe stocks is the best way to keep up with market trends and avoid losses. The stock market can be unpredictable at times, but it's best to protect yourself by investing in less volatile stocks. Investors should also focus on long-term investing, rather than short-term speculation, in order to reduce their risk in volatile markets. What causes stock market crashes, and how can you protect yourself? In financial markets, crashes can happen suddenly without any warning. The most common cause of a stock market crash is a sudden change in investor sentiment. The mood of investors suddenly changes and they start to fear for their investments. One example could be a sudden change in public opinion towards a company's business model or its leadership. Investors retreating from the stock market sends prices plummeting, and oftentimes, this rapid change can lead to other unpredictable consequences such as economic recessions and financial crises. A brief history of stock markets and collapses. A stock market crash is a momentary decline in the stock market, often in response to some negative event, such as news of a new regulation, significant policy change, or temporary hardware failure. Although there are many reasons for which stock market crashes happen, the most common reason is because of the exuberance of investors who buy stocks with no regard to their value. The crash of 1987 was one of the most devastating crashes in history. It led to a 30% loss in value for all U.S. stocks and caused 27% unemployment to hit that year. This crash eventually led to a recession that spanned 7 years. It also led to reforms in order to prevent future crashes from happening again. The Great Recession was a stock market crash that led to the most severe and long-lasting economic recession since the 1930s. The U.S. equity markets fell by more than 50% from mid-2007 to early 2009. It began with the bursting of the housing bubble and reached its nadir in September 2008 with the collapse of Lehman Brothers, a large investment bank. Stock markets around the world suffered huge losses during this time period, which led to many people losing their homes and saving accounts. Many countries saw their GDP drop significantly due to how much money was lost during this time. The act of protecting your investments. The first factor is to have a diversified portfolio. The best way to protect your investments against this type of risk is by diversifying your investments and not putting all eggs in one basket like many investors do. The second factor is to always be aware of the stock market and its current trends. If you see a company going bankrupt, it's important to know what possible moves they may make soon after and on what date they might do so. Investments are always risky. The stock market crash of 1929 is a good example of how investments can turn into losses rapidly. Why should you protect your stock investments? Protecting your investments is crucial for your financial survival. This is especially true in the era of the cryptocurrency market, where stocks, bonds, and other investments are highly volatile and prone to sudden drops in value. The current market is volatile and unpredictable. The risk is high when you invest in the stock market. However, you should never forget that your investments are only as good as your protection plan. If you don't protect your investments, then the risks will become too great and it will be hard to recover from any misfortune. It's important to always protect your investments by having a wise plan in place to deal with any unforeseen events that may occur. It is important to note that not all investments are safe in bear markets. The stock market can be one of the most secure places for your investments, but only if you pick the right asset allocation at the right time with the right amount of money. You should also consider how you will react to market volatility. By diversifying your portfolio, you reduce risk and make sure no single investment goes down too drastically with time. What are some safety steps to take when markets are falling? Let's start with some basics. Some of the major things that you should do to protect your portfolio and future investments is to take a risk management course or read up on risk management books. Hire an advisor who will help you create a plan for your portfolio and retirement investments. Create a private investment account where you can keep your personal and retirement funds safe from market volatility. How can you protect yourself from a financial crisis? Financial crises in the past have often been referred to as black swans. The term was coined in 2007 by investor and author Nassim Nicholas Taleb. They are unpredictable, sudden, and unpreventable events that can lead to widespread economic damage. There are many ways to protect yourself from a financial crisis, but not all of them are easy or even possible. One way is to invest in the stock market, which is typically much less risky than other investments like bonds or real estate. Another option is to start your own business or invest in other businesses by buying stocks or shares, so you have an equity stake in their success. The final option is to choose a high-yield savings account. This type of account could pay more interest than a regular savings account. Emerging economies around the world are experiencing financial crisis after financial crisis. However, some can also be avoided by avoiding certain investments in their economies. In the last few years, most of the emerging economies have been going through a financial crisis. There have been over 10 major emerging market crises in the past decade, and most of them happened in 2008. The common trait in these financial crises is that they were unexpected and caught most investors by surprise. In a nutshell, these crises were primarily due to one or more of the following factors: a sudden surge in interest rates, an event like an earthquake or hurricane, the inherent instability of emerging markets due to their disproportionate reliance on natural resources for economic development. You need to know where you're putting your money and what. There are many countries that have different currencies than the United States dollar and Europe's euro, so it is important that investors understand what they are getting into when they invest overseas. Tips on how you can avoid losing out during a stock market crash. Don't invest with borrowed money. If you need to borrow money for investing, ask your family or friends for loans rather than using credit cards or taking out a home equity loan. In addition to stocks and mutual funds, invest in real estate where you can get more value from the property over time without having to worry about the fluctuating value of the company's shares and your financial stability at all times. Only invest at your own comfort level. You should only invest money that you can afford to lose. Invest in stock funds. Stock funds are assets that a company holds instead of cash. Stock funds can be a range of different types including stocks, bonds, commodities, and even other companies. Stock funds are an investment instrument that offers the ability to invest in a company's capital without having to physically buy its shares. In this sense, it is similar to a mutual fund as these invest in many different securities, as well as cash equivalents, such as bonds and other financial instruments. The stock market is one of the most expensive markets in which to invest, and it can be difficult for retail investors or small companies to trade on their own without having access to large amounts of capital. With stock funds, investors can purchase shares at a discounted price and take advantage of returns from the company's stock over time without the hassle or risk associated with trading. What you need to know about trading with these funds. The funds are divided into two categories: funds with a high asset value and funds with a low asset value. Funds with high asset values usually have red-hot active traders who are often looking for short-term profits. Funds that have an online trading platform that is safe, secure, and reliable are usually worth investing in. If you want to invest in the fund, you should take note of the following points to make sure your investment goes well. The entry strategy of the fund is important because it tells investors when they should enter and exit the fund. Entry can be when the share price rises or when it falls down. The trading plan of the fund might show what kind of trading strategies they will use to generate profits or losses in stock market. Invest in funds that make sense for you and your situation. One thing that many people don't consider when they invest is the fact that there are different types of funds. It doesn't always have to be a mutual fund, but it can also be a hedge fund. Hedge funds have been around since the 1970s and have exponentially increased in popularity in recent years. They provide a lot more potential for higher returns than a regular mutual fund, which is not surprising considering hedge funds typically charge high fees. A hedge fund is essentially an investment vehicle for highly skilled traders and investors with deep pockets who want to make money with stocks and bonds trading on high-risk, high-reward situations. What should be the next purchase after buying a good fund? To make the most out of your investment, it is important to know what will be the next purchase after buying a good fund. First off, you should make sure that the fund has appropriate risk level for your goals. For lower risk investments, you should invest in low-cost funds like GIC or bonds. If you are looking for high returns, then mutual funds can provide an excellent return on investment. If you are looking for more stability and added benefits like tax efficiency and compound interest, then consider investing in an ETF. The next purchase after buying a good fund should be stocks or shares in market cap listed companies that meet your risk criteria and also offer returns on investment close to what you received from the fund itself. Top 3 ways to protect your investment when stock prices crash. As the saying goes, the best time to make a deal is when there's blood in the streets. We are living in a time where every business is looking to be relevant and compete with their competitors. But this has led to an increase in competition that has made it hard for companies to stay afloat. When this happens, it could be the perfect time for you to invest your money. The following are 3 ways to protect your investment after a market crash. 1. If you want to invest in the market, take a look at which companies have been giving out dividends for a while and buy shares in them. 2. As a buyer, don't try to jump into the hottest stocks. Wait for them to calm down before investing in them. 3. Buy low and sell high by doing your research on the latest trends and potential markets before jumping into any investments. Some of the risks that investors should consider when investing in stocks. There are some risks that we should always consider before we invest our money, such as investment risk, market risk, and business risk. The first type of risk is investment risk, which is the chance that the investment does not meet its objectives. The second type of risk is market risk, which occurs when the stock market experiences a crash or crash-like event, such as a black swan event. Finally, there is business risk. This can include factors like tariffs or political unrest. Before investing in stocks, it's important to calculate these risks so they can be identified and mitigated. Protecting your investment from a stock market crash requires active management. Risk versus reward in stocks. I'm going to break this down into 3 parts: risk, reward, and how to put them together. We will start with risk because it is the most important part of this equation. Risk can be defined as the possibility of losing something of value, such as money or securities. The greater the risk, the higher the potential reward associated with that risk. If we want to be able to identify which stocks may have a higher probability for success and which ones may be too risky for us, we need an understanding of what it means for a stock to have a low or high risk factor. As a beginner investor, you may not have the time or the expertise to develop a trading strategy. However, you can use a screening method to identify which stocks may have a higher probability for success and which ones may be too risky for you. How to reduce risk when investing in stocks? There are 4 main ways to reduce risk when investing in stocks. First, diversify your investments. Second, invest some money in mutual funds and exchange-traded funds, ETFs. Third, invest more money into stocks that are making progress or growth. Fourth, invest more money into stocks that are making profits. Diversification key for protecting your investment from a market crash. When a stock market is booming, it can be tempting to invest in a company that makes a lot of money. However, diversification is important for protecting your investment from a potential crash. If you have invested in 5 different stocks and one goes down by half its value, then you can breathe easy knowing that your investment is safe. Protecting yourself from a stock market crash by avoiding certain companies with low financial independence. The stock market can be a very unpredictable and sometimes volatile place. People may invest in stocks with the highest returns, but at the same time, they need to realize that they are taking a risk. When some companies have lost more than 90% of their value in just a couple of years, it is apparent that their financial independence is not as strong as it appears. Some people might decide to invest in those companies even though they know that they might not survive and thrive on the market. Investors can better protect themselves by avoiding certain companies with low financial independence and investing in those with higher percentages of financial independence. Investing in these companies may be risky, but there is more to gain than there is to lose by doing so. A simple strategy to protect your investment from a financial ruin. Whether you are an individual or a business, it's important to protect your investment from a financial ruin. If you don't have enough money in the bank to cover the cost of living, then what you should do is increase your income. 2 ways that you can do this is by increasing your salary or cutting costs. The strategy for increasing income is easy. Just find a way to bring in more customers and grow your business faster than anticipated. However, cutting costs can be difficult because there are so many different factors that affect how much money it takes to run a company. One factor that has been found to be instrumental in lowering costs is automation. Not only does automation help reduce labor expenses, but it also helps businesses grow faster than they would otherwise. It is important for people to know that investing in the stock market can be difficult. It is not always easy to figure out when the market will see a crash. However, it is important for investors to know what they are doing so that they don't get completely wiped out. You should identify your risk tolerance level and use this number as an indicator of how much you should invest in any specific investment. You should also consider your investment horizon and then invest accordingly. 8 ways to protect your investments from stock market volatility. Stock market volatility can have a detrimental effect on your investments. In order to protect your assets, you should consider the following 5 ways. 1. Trade in advance of news releases. 2. Buy stocks with low volatility. 3. Invest in bonds or low-risk funds. 4. Limit your investment to just 10% of your annual salary or below. 5. Stay away from penny stocks because they are highly risky investments. 6. Focus on blue-chip stocks with long track records with no major earnings miss for at least 5 years. 7. Use stop-loss orders when necessary. 8. Expect crashes to happen regularly. Conclusion. Some people have found success in the market by investing in companies with long-term potential. Sometimes market crashes can also present an opportunity to buy stocks that might be on the rise again later on. In this era of high-velocity financial markets, it is important for those who invest in stocks to be ready prepared for any fluctuations. In fact, as a new era of regulations has been ushered in by the United States Securities and Exchange Commission, investors must be more cognizant of their investments than ever before. This means taking steps to safeguard your investments from potential losses. In today's world, it means protecting their money from an impending crash that may never happen or a sudden downward spike that could leave you completely broke. So there you have it. If you enjoyed this video, smash the like button now and subscribe to our channel to be notified when new videos are released.